Good afternoon and welcome to our webinar where we're going to be talking about the defined benefit environment as it stands today. My name is Richard Chari and I'm a senior consultant in the corporate defined benefit team. I'm joined here by my colleague Chris Levell, who I'll be talking to and he'll introduce himself in a moment just so we can get a sense of how we see the world. Before we get to that, I just wanted to run through a quick few compliance items. Really, the key takeaway here is that we're going to be having a more general discussion just around our views and not necessarily a specific recommendation to anybody. If there is anything that you'd like to discuss further and see how it affects your specific plan, please reach out to your consultant or Chris and I after this. With that out of the way, I just wanted to let you know that we'll be taking questions at the end of our discussion. Feel free to reach out to ask any questions as we go through. There is a chat box in the webinar panel that you can use to ask questions. And we have our colleague as well, Kelly Regan, who's going to be assisting us with those questions. We will also be having a replay available in the next few days, available at our website, NEPC.com. So for those folks that have other people in the organization that could not attend today and would like to share this, this again will be available for you in the next few days. So as most of you know that we typically have our client conference sometime in May, and given again the impact of the pandemic, we had to cancel that. And instead of having a series, a one-day of virtual webinars replicating the conference, we decided and instead to find different ways to still communicate and speak with clients. We've been having a number of series of conversations with our Chief Investment Officer, Tim McCusker. He spoke with industry leaders within the investment world, folks like Bob Prince from Bridgewater, Rick Reeder from BlackRock, George Walker from Neuberger Berman, and has got one that's scheduled next week here, speaking with Cliff Asnes from AQR. So please be on the lookout of that. Again, all those replays are also available at nepc.com. We do have one, again, the way that we ended up deciding to in lieu of the client conference, to then have these broad conversations and then also have targeted conversations to a particular client segment, and this one being one of them. We know that most of the folks that we work with touch both the defined benefit plans as well as the defined contribution plans as well. We do have one focused on defined contribution plans that's coming up in sometime in July. We're actually in the process of conducting a flash poll, just asking questions around, how are folks reacting to the pandemic. There've been layoffs, there've been furloughs, job cuts, amongst other things. There's things like matching strategy, are folks changing that? So please feel free to participate. We encourage you folks to again participate in that flash poll. Ross Breeman will actually be will be going over the results of that sometime in July. So please be on the lookout for that. So with that out of the way, wanted to have Chris take a moment to introduce himself here. Chris has been with NEPC for a long time, and some of the folks that are on the call here recognize him, but we also have folks that have never worked with NEPC. So Chris, why don't I turn it over to you to introduce yourself? Yeah.
Well, I'm not sure if people will recognize me if they can see the video and see that I've got my my COVID beard in place. Yes, I've been with NEPC, Richard, for 15 years. Was the first credentialed actuary to be hired by NEPC. I think people were worried about having actuaries, and now I think we've got 6. So that's kind of a sign of where corporate pensions have gone. My previous career was in a short stint in insurance out of college, and then worked at Mercer as an actuary and as an investment consultant. So, my background in corporate defined benefit, goes back quite a ways, and I've been involved in a lot of the topics we're going to be talking about today. Right now in NEPC, I'm in research on the asset allocation team, which allows me to actually work with a lot of clients, and so yeah, I think a lot of folks have seen me, and frankly, one of the benefits, I guess maybe not benefits, one of the things on the positive side of the ledger in everyone kind of sheltering in place has been that I can't go to 30 client meetings a year around the country and make it work, in my schedule. However, I'm on a pace probably to meet with 30 or 40 clients, just doing what we're doing here. Everybody sheltering in place and having a call. That might be one of the things that changes in the future, is that we'll be able to have, senior people from all kinds of organizations that have an opportunity to have more contact, as long as we're not traveling physically as much.
Perfect, thanks, Chris. So Chris, as we were thinking about what sort of format this discussion is going to take, we ended up settling on a fireside chat. And as myself, as a new citizen, you end up asking me whether I knew how that phrase fireside chat was coined, and you shared with me some pretty interesting information. I thought maybe it also just kind of useful for other folks that might not know how it came to be, if you can maybe just give some folks a little tidbit on that term, fireside chat.
Sure. Yeah. And the Chief Investment Officer series that Tim's been doing, we've been calling those fireside chats as well. I think part of the focus here is that it's a chance for us to be rather free flowing in the conversation, see where the conversation takes us. But my understanding, and I could be wrong if there are historians out there, my understanding of where the fireside chat idea started was when Franklin Delano Roosevelt was president. And everybody had their radio, and that was their connection to the outside world in the Great Depression. And so he started doing these conversations directly with the American people, which, other than people being on the campaign trail, was not something that presidents had done in the past. So that sort of connection and the ability to speak directly to folks during what was a very difficult time back then. And so I think fireside chats come down to us as something, as a chance to be a little bit more relaxed, a little bit less structured, a little bit more free flowing in the conversation. And I hope that this works well for everyone who's called in.
Great. So with that, I think this was also at a time when FDR was having this fireside chats, was during a time around the recession, World War II, times of despair, finding kind of like a less formal way to communicate and be there with folks. Again, we're trying to come to you in the same format here. So there's some things that we may scratch on the surface and maybe not go deep with that. To the extent that you need, again, a lot more depth, certainly feel free to reach out to us folks here. With that out of the way, so Chris, maybe let's just take a step back. A lot has happened within the markets. There was a time, I think, going into the year, nobody could see how this year's unfolded. Can you maybe just walk us through what's happened in the market from just a return perspective, and how even our themes and views have changed since the beginning of the year and up to where we are today?
Sure, yeah, as you know, that's a pretty big topic. It's been something that on our fireside chat series we've been discussing with a lot of folks, and I think everyone knows that so much of what's happened has been completely unexpected, from the pandemic, the first real global pandemic we've had in decades, and what that led to in the terms of lockdowns, what it led to in terms of job losses, and really the uncertain future. If we look to the markets, the equity markets bottomed out so far. The bottom is March 23rd, and they've been pretty much straight up since then. Although last week there was several days of downward move that looks like we might be eclipsing again this week. So rather extraordinary big moves up and down in the equity markets, and I'll touch on what we think is driving some of that. And then another thing that I think is really important to all of our corporate clients, whether they're pursuing liability-driven investment or not, is that U.S. interest rates in the form of Treasury rates have actually blown through their all-time lows, and we've got the lowest rates in history, and a lot of conversations around that I know Richard will be talking about today. We don't have a lot of slides today because this is a fireside chat, and we're also prepping for our 6:30 assumptions and themes. So we will have updated things to present to you in your third quarter meetings. I did want to maybe frame though what's happened this year in the terms of our key market themes. I think most of you have seen these. We don't design these as things to be changing every quarter to quarter, but we do look at them. And of course, the new theme you see on this page is virus trajectory. We think that it is really dominant in everything that we see for life, but also for the investment markets. And you look at the times in February and March, last week, you look at the times when there's been negative markets and strong negative sentiment. That's come from bad news coming on the virus front, and the belief that we're not going to get out of this, that the return to normalcy is going to take much longer. Richard talked about what kind of recovery is this right now? It looks like a V-shaped recovery, but people talk about, is it a W? Do we have another down leg? Are we going to test those lows again? Is it going to be relatively volatile but fairly flat the rest of the year? A lot of it will depend on the virus trajectory. And we know that many states have relaxed restrictions. We're seeing a lot more social gathering. We're seeing non-social gathering in the form of protests as well. And all of those things will play into what the future of the virus is. There are a lot of things we don't know. We don't know, places like the World Health Organization, the CDC, have actually had conflicting data, and the reason for that is that they're not changing their mind, other than in the sense that they get new data in, and new data leads you to new conclusions. So things like wearing masks, separation, being inside versus outside. I'm sure we've all heard many things on all sides of those issues, and I think that's going to continue. On the talk that in our CIO series this week, one interesting point in considering whether non-symptomatic people can transmit the virus, the point was made that the best efficacy of the swab test to see whether you've got an active strain is about, and now I'm not going to get the numbers right, but good reason to go back and listen to that talk. But let's say it was something like 84% on day 7. So that means 16% of the time the test was wrong. And of course, being wrong can be that it's a false positive or that it's a false negative. So sometimes when we hear about people that had the disease and then didn't have it and have it again, or some of the weird things you've heard there, that can just be hidden in the randomness around how good our tests are right now. So virus trajectory is going to be dominant. It's going to be a key theme. Going in, even if things get better and better as we work towards the end of the year, I think there is a natural fear in thinking about other viruses that the winter months, usually infection rates go up and there are more problems. So people are concerned about that, even if the rest of the year goes well. But I think importantly, as we turn to what does this mean economically, our permanent interventions theme, which is something that we added last year as the Fed started really not only responding to keeping inflation low and employment high, but really started focusing in on market sentiment. We thought that was a pretty material shift, and sure, this has been something that's gone gangbusters this year with not only what happened in the Fed funds rate, not only what would happen with quantitative easing that's on a size and scale much larger than the prior 3 combined. We also now have on our permanent interventions a theme, something that we expected out of this theme, which is fiscal intervention. So the CARES Act, combined with what the Fed has done, represent 25% of GDP that's come in the form of fiscal and monetary stimulus. And we don't see that ending. If anything, when this first theme, the virus trajectory, has some negatives coming in about it as it introduces some volatility to markets, we expect now the Fed to step in and provide liquidity. Things like the Fed buying high yield ETFs to keep their liquidity going. Fed announced earlier this week that they can step in and buy individual credit bond or individual issuer credit bonds, like the central banks in Europe and Japan have been doing for a while. So all those things speak to a Fed that's data driven, that's responsive to what's happening in the markets. And then an ongoing question is, what are the long-term impacts of that? and something that, we've heard very smart people across the board have very differing opinions on where that goes. And then on the fiscal side, the CARES Act was a big part of why March 23rd was the bottom, because Congress was expected to have fiscal stimulus in March, and as it dragged on and as the politics continued, the market was getting very, very skittish. And then I believe the CARES Act was passed later that week, and signs that were going to pass let us out of that bottom of the market. And that also speaks to investors and says, look, fiscal Congress is going to do what it needs to do this. Now, of course, we know as it tries to speak to the individuals that are suffering both with illness and job losses, as it tries to speak to industries that are heavily impacted here, as it tries to repair all these things, it's not going to be, a fine piece of machinery in addressing all those needs exactly. So, this falls in what's been called a round of things that Congress are going to do. And I think while the HEROES Act, which has passed the House, isn't likely to pass in its current form to the Senate, I think it does have that theme, I guess minor theme, not an NEPC theme here, that because the CARES Act was about $2 trillion, this next act, whatever form it takes, is probably going to be something a little bit bigger than that to address how tough this has been for everybody. Like I said, at the individual level, at the company level, at the sector level. So
Chris, we may come back to.
This is when Richard says, Richard's like, okay, let's move on. Okay.
So we'll come back to that permanent interventions and just discuss generally what that actually means for plan sponsors. Again, the relief, funding relief, amongst other things. So just moving on and with that evolution of our market themes, we've since changed for folks that generally that have worked with us in the past. Our assumption setting process, there have been two key changes within the process. Number one, it's in the short term, we produce two sets of assumptions, short term and then long term. And the short term assumptions, we've changed and increased the investment horizon from a 5 to 7 year period to a 10-year time horizon. And then at the same time also, we've moved from an annual process to producing this on a quarterly basis. Chris, just wanted you to talk about what this actually means and why those changes. Does it mean that folks have to change and reassess their asset allocation on a quarterly basis with us producing those new assumptions more frequently now?
Actually, I could give a quick answer here and just say no. It does not mean that, but I'm not going to give a quick answer. Yeah, so maybe I'll disconnect them a little bit. Just to tie this together. When you look at what our 5 to 7 year assumptions were, and you worked with your consultant on asset allocation issues, we looked at that as being a forward-looking market cycle environment. And over the years, over the last 2 cycles, we've had much longer market cycles. With the current one, well, I guess it's not the current one anymore, with the past cycle that ended with the recent recession being the longest recovery in history. We think that in this world of central bank action, we are looking at longer cycles. And so moving out to 10 years, I think, made sense in terms of that's still a strategic asset allocation period, but we just don't think it's going to be 5 to 7 years anymore. We also look at an industry that has moved over time. A lot of folks now look out to longer periods because there is a lot of intervention, as I just said. We retain the 30-year assumption. I think that's very important for plan sponsors when they're trying to look at what their assumption should be on the actuarial side. And then speaking to the quarterly assumptions, as I said up front, we do not at all want people to look at quarterly assumptions and be rerunning things because, again, these are 10-year assumptions for asset allocation. They're not really changing that much, but in years like this, where we saw really strong negative returns in the first quarter and really strong positive returns in the second quarter, our assumptions are going to reflect that. When you have the big gains this year, that means that our forward-looking assumption for equities is going to be coming down a bit when we look at our June assumption. So ideally, what we'd like each client to do is investigate their own circumstances. For many healthcare organizations, they have a 6/30 fiscal year. I think it would make a lot of sense for them to use this 6/30 set this year or in future years as being, you know, the fundamental place where they look at assumptions. I think other clients may stick to looking at the assumptions that come out in January of each year as being a good assumption. And, you know, I also think a lot of clients in the corporate space that have calendar fiscal years and really want to know what their expected return is going to be in advance of that fiscal year may use our 9/30 assumptions. You know, as Richard, as I know you know, and as many clients may know, we actually prepared our annual assumptions based on 11/30 data so that we could get it in the hands of our corporate clients by December 15th. Now we're going to have a 9/30 set that's going to be available on October 15th. So we're actually going to have 2 months of, you know, additional time to make sure that the assumption is good for those clients. So in summary, please don't use assumptions every quarter. Figure out, based on your objectives, what you're trying to achieve as fiduciaries, what makes the most sense to hone in on as a good time for assumptions.
Thank you. So let's just take a slightly different direction here. So again, with one of the themes of the permanent interventions, we've ended up in this lower for longer environment where rates are pretty low. And for folks that, again, we've got clients that are on different sides of the spectrum here and some that are in the middle in terms of hedging their liabilities or pursuing total return approach. For folks that have reaped gains within liability hedging assets, how should they think about hedging going forwards? Is there any more upside of holding some of these assets? Should folks be abandoning duration? Can you maybe just walk us through, again, in how we see the world when it comes to hedging liabilities and some of the implications of maybe abandoning duration at this time?
Sure. Yeah, if there's any statement that I've heard more in my career that has been consistently wrong for like almost every year in 30 years, has been interest rates can't go any lower than they are right now. So, you know, the caution that we have for our clients that have pursued a hedging structure is that even though interest rates are historically low, we do know they can get lower. Richard, maybe we'll talk a little bit about negative rates, what's happened in Europe, but the key point being that even though rates are low, they can go lower. So if one of your key risks is matching your liabilities, and the liabilities are going to be going up when interest rates decline, we still very strongly believe in those hedges. And then maybe to disconnect a couple pieces there on the hedging side, you mentioned, you know, very strong returns, and that's true. If you had Treasury strips, Treasury futures based hedges in place, you've seen incredible returns, you know, triple-digit returns over some periods because of the decline in rates. That's going to mean that relative to everything else that's happened in the portfolio, you probably have too much in those assets. So, you know, as we said at the end of the first quarter, if you've got gains there and you can harvest them, get back down to targets, and maintain your hedge ratio, that's a great way to look at this. You know, credit spreads are higher, so you know, you may look for an opportunity to add to long credit strategies. Although the timing on that and the cost of that, and just in transaction cost, is fairly high. So it's, you know, there's been enough volatility that it's difficult to say when's the right time to move. In general, though, you know, we believe in definitely maintaining your duration. Keep in mind that when interest rates are as low as they are now, the duration of your liabilities has also gone up, and that's, you know, technically called convexity. The fact that not only does your liabilities rise as interest rates fall, the duration of liabilities itself rises, and that's convexity. So, you know, a hedge that you've put in place in times that were a lot less volatile than now still makes perfect sense in going forward, not knowing what the future holds.
Thanks. So I'm just going to piggyback off some of those comments that you made there. So you talked about lower or negative interest rates. If we end up seeing negative rates in the U.S., what does that actually mean for corporate pension clients, and how should folks be thinking about? There's an implication on the liability side of things, and then also from an asset allocation perspective. Can you maybe just talk to us about what negative rates mean for pension investors?
Yeah, this is one of those times it was kind of ironic that our chief investment officer, Tim McCusker, had the idea of writing a negative rates paper. It's clearly something we've seen in Europe and Japan, last year. And so, he wrote saying, what do you do with that as an investor? And the general response is, if you're outside those regions, if you're a US investor, yeah, it doesn't make sense to buy bonds with negative yields. But he also looked at, does it make sense when that's the area where you're hedging something like liability? And he looked at what happens if negative rates become pervasive and even US moves into negative rates. So this was more of a thought piece when he wrote it, and it ended up becoming, an actual working piece to say, what would this mean? And we do think that if Treasury rates were to go negative, we do think that there still is a place for using them in hedging to a limited extent. Certainly if they get very negative, then you just have the general challenge of you do not have a natural hedge. The general belief in the actuarial community is that even if interest rates are negative, they're probably not going to discount at a negative discount rate, which would mean that the liability you hold would be larger than the sum of all your benefits, which is counterintuitive. I think another really key point here for plan sponsors to think about is that you are discounting, in almost all cases, your liabilities to credit-based yields. And what we've seen in March, in last week, at these times where treasuries have been a flight to quality and these yields have gone down, the 10-year treasury got below 40 basis points in early March. But at that very time when treasury yields are going down, there's also a flight away from risky assets, which includes credit. So actually credit spreads have been credit spreads have been volatile. The credit yield, the combination of treasury yields going down and credit spreads going up, has meant that credit yields have actually been, if not stable, they've certainly not been as volatile as most markets. So it's hard to picture in this environment with the pandemic and permanent interventions, something that could drive credit bonds below zero, because the flight to quality to treasuries tends to make credit spreads go up. So our belief would be that this is a good conversation to have about what would happen in a negative rate environment, but we don't think it's going to apply in the sense that you're really going to have a negative discount rate going forward.
Yeah, thanks again for that. I think we're going to try and move a little bit faster here, just maybe pivoting things to credit markets. So at the beginning of the year, we did talk about spreads widening and then being an attractive entry point for clients that wanted to still maintain duration, but also look at return potential from an opportunistic perspective. Does it still make sense, given that, again, we've seen that reversal of spreads? Spreads have come back in. Does it still make sense for clients to be considering investing in long credit? And what are the concerns within that category? So we've got things, again, triple Bs have been the rise of triple Bs within investment grade mandates has been an issue. We've got things like issuer concentration. Can you maybe just walk a little bit faster in terms of how we see the world in credit markets?
Sure, yeah. Credit bonds are certainly going to be part of the toolbox for managing liabilities, because liabilities are discounted credit bonds. They're not 100% hedged. We've got the concerns that Richard just raised that I'll touch on, but they're still always part of the puzzle. And depending on the facts and circumstances of individual plan, it can certainly make sense to increase or buy long credit in this environment. As Richard said, triple Bs are the largest they've been of the investment grade index. We know that there are going to be, and we've already seen downgrades happening in that space. A lot of strategies out there that our clients employ are based upon benchmarks, and those benchmarks are going to change. Anybody that becomes a fallen angel and goes from triple B to junk status just falls out of the index, and that can be a concern. So this is a place, there are places where active management has really not performed the way that we wanted it to over the past several years, and especially even in the first quarter. But active management in credit makes a lot of sense because managing around those credit challenges are important. And like you mentioned, just in the final analysis, keep in mind that credit benchmarks are based upon issuers. So the largest percentage of any bond index is the company that issued the most debt in that space. And if you take that apart a bit and look at it, you might not want to hold the company that's actually issued the most debt. A cautionary tale here is that I think PG&E was one of the top 5 or 10 issuers if you go back 4 or 5 years, and now they're junk status. So credit management I think is really important, and our list of managers that we like are very focused in on avoiding. They can't get away from them completely, but trying to do a lot of strong credit management so that they have bonds that'll be money good, but also keep their ratings through to maturity.
So just adding on to that as well. So again, we're in an environment where we think that the impact of downgrades and defaults is a little bit elevated. And so we recommend folks to have programs in place to manage some of those fallen angels. Again, downgrades affect liabilities and assets in a different way. So in the end, assets end up decreasing while liabilities end up increasing because that bond gets taken out of the index to discount the liabilities. And then along the same lines that you talked about, Chris, just the credit indices and the inefficiencies there. When we're thinking about an evolution of LDI, we've got, again, some folks that are thinking maybe down the road what an insurance portfolio might look like, and perhaps maybe this is what ends up being a mandate that a pension plan manages the assets. Can you just give us a quick few comments on that evolution of looking at a portfolio like an insurance company?
Yeah, sure. Certainly the way the insurance company backs up a pension liability that they take on through an annuity to purchase is using bonds. So in that sense, it's not very different than a corporate plan sponsor, but completely different regulatory structure. And so they care very much about issuer concentration, about sector concentration. And so their portfolio bonds looks pretty different than one that's based upon an index. We do think that, and we're talking with investment managers about this, that working towards diversifying LDI assets that are a little bit more liability focused and thinking a little bit more like an insurance company, we think that's a way that things are going to go. One connected point there that I know we've got a lot of folks on the line that are sponsor cash balance plans, and I think several people internally, externally have heard me say this, but the best information we have is that while you can settle your retired annuities at somewhere between 100 and 105% of your PBL, what you're holding in the liability, when they see a cash balance benefit, especially for actives, you're talking about a premium of like 20% over what you're holding. So we think even for those of you with frozen plans, you're going to be in that, you're going to move towards that stage down the glide path towards essentially managing this liability risk like an insurance company. And as the cash balance benefits eventually become annuities, then they become attractive for insurance companies. So we're, within the next 5 to 15 years, I think many of these frozen plans are going to be, frozen plans that are cash balance plans are going to move towards being still a self-managed pool of assets, but one that's treated like more with an insurance type structure. And that's something we're working towards in the coming years.
So since we're talking about insurance companies here, why don't we just pivot to pension risk transfer? I was a little bit surprised to see the numbers that came out from LIMRA, the insurance tracking organization, talking about the number of annuity buyouts that were done this year. So $4.5 billion as of at the end of the first quarter were done in risk transfer. Chris, is this the year for folks to be thinking about when we think about pension risk transfer? It's lump sums, it's partial annuitizations, and plan terminations. What sort of market is this for people that are considering shrinking that liability?
The first point I'd make is that I think that this is less opportunistic with where we are in the market environment than it used to be, in the sense that now that corporate plans have moved towards more current mortality, the difference is, like I said, we're talking about are the 100 to 105 range. And so I think it usually does not come down to somebody saying interest rates are low or interest rates are high this year. They say, are we willing to stomach putting $50 million in the plan to be done with it and terminate? And I think most of that $4.5 billion in the first quarter was actually terminations, less so than partial risk transfers. So I think on the annuitization front, I think that that's going to continue every year. We're not seeing a lot of activity from our clients because I think they've done more in past years. The lump sums is an interesting one, just in the sense that there is some optionality there in lump sums. In a year where interest rates have gone down, you can offer terminated vested lump sums based upon the previous year rate. And so those are the years where we saw heavy activity. That's certainly the case this year, in the sense that rates have come down quite a bit, as we know. But we're not seeing a lot of lump sum activity. And part of that is, I think the clients that wanted to do it have already done it once or twice, and they don't want to fall into a habit that could get them into some accounting difficulties. So I think that will continue. Big piece of this, and maybe this is the next pivot, Richard, is what exactly are the rules going to look like? One of the reasons that these activities have been popular is you've got those big PBGC premiums every single year. So when you do a risk transfer, you're eliminating those PBGC premiums. We don't know if there will be any changes on that front.
Okay, and then just again for building up on that too. So if a client is considering any sort of risk transfer, certainly feel free to reach out to your consultant as soon as possible. The investment strategy that we tend to adopt for a plan that's trying to do anything in terms of taking a risk off the table tends to be a little bit different from an ongoing plan. There's things to consider, like, does it make sense to do an asset in kind transfer? How should I think about retaining risk assets? And so again, it's something that we are aware of and would encourage you to reach out to us as soon as you know that you're considering that. Just maybe pivoting, you mentioned the PBGC government-related issues. There's been, again, funding relief. The CARES Act that was passed had a contribution holiday that allows folks to defer the contributions this year into 2021. Plan sponsors and lobbyists were seeking for a lot more things. And now we've got the HEROES Act that's been passed by the House, but it's still in the Senate. What are the conversations that are happening around government interventions, again, coming in to provide relief for plan sponsors?
Yeah, I think that, this is I could give a very long answer here, and I'm going to try and make it as short as I can. Fundamentally,
short will be better.
Shorter is better. Fundamentally, when the PPA was put in 2006, the idea was you use market interest rates for a pension plan, you pay your contributions over 7 years. And of course, we had the financial crisis that changed that. We had funding relief from that. We had funding relief come along and actually became a tool in any bill before Congress, because funding relief actually increases government revenues. So there's an alignment of interests with plan sponsors. We have to believe, whether it's the form that's in the HEROES Act or something else, that there is going to be broad-based funding relief for U.S. pension plan sponsors, because just think of the horrible dislocation that's occurred in so many industries. So we don't know exactly what form that's going to take. Certainly now we have quarters, those can be extended. We have a 25-year look back in interest rates. There's talk of having a 50-year look back to interest rates. So we're getting those nice double-digit interest rates of the 70s into the calculation. So those are the mechanics around what's going to happen. I'd like to speak to you as to what we think is going to be the actual thing that happens here. I think most clients going into this year could reasonably expect to have to pay their underfunding over let's say the next 7 years as everything from the corridors wore away. I think that that's now pushed out in some form of funding relief 3 to 5 years. The other side of funding relief that is really uncertain to me is that in the past, funding relief so giving contribution flexibility to sponsors has always been combined with also having higher PBGC premiums. And there's certainly lobbies internal to the government and external that want to see those PBGC payments continue to increase. But our clients, all the sponsors we talk to, recognize that these are very onerous fees that aren't doing a thing for participants, for entities that will be viable and pay them their pensions. So there is a move to actually reduce PBGC premiums. Again, I don't know politically whether that has legs. So expect not to have to, we've gotten, as Richard said, funding delayed to the end of the year. I have to believe something passes this year that pushes things out 3 to 5 years until we get past the pandemic.
Okay, great. Yep. So we've got about maybe 5 minutes before we turn to questions. Yeah, so if we can move a little bit faster on the remaining topics here. So just some thoughts on some folks have experienced funded status losses this year and have a glide path. How should they think about re-risking their portfolio? And then if you could also talk about some opportunities that we see within return-seeking assets as well.
Sure. And yeah, I'll be brief here because remember we've got a 6:30 assumption set come up here. We're doing a deep dive into questions like these. When we have looked at re-risking just generally, taken models of the past, taken simulated models, and looked at whether not only de-risking as funded status improves, but re-risking as funded status falls along the glide path, we got some mixed results, and we didn't necessarily get better results for re-risking. So, I think the big majority of our clients just have a glide path that goes one way. We do have some that re-risk, and if you can imagine, if you had looked at the markets on March 27th and said, okay, where funded status has dropped quite a bit, we're going to re-risk today, that would have worked exceptionally well. I think it's a challenge when you've got to get the numbers, you've got to look at the numbers. You're probably evaluating things in April or May when already we had some strong returns. So I think it's something to consider, but it's also something that has governance issues around making that happen. And then in terms of return-seeking assets, we've made some changes to our views. A lot of things that looked particularly attractive at the end of March have had fantastic returns. So I don't think there's a lot of low-hanging fruit, but we'll certainly be looking across research to see what the opportunities are going forward. One of the challenges that we know there is for corporate plans is that we do think that more opportunities are occurring in the private markets, and that's not something that a lot of corporate plan sponsors want to get into, so that they can stay liquid in the hopes that they could terminate the plan if funded status improves enough.
Thank you. So just in short again, so for some folks that did not re-risk, I think we've rebalanced as a means again to add back into assets that sold off and take gains from things that did well. And then for folks again, and within the total return spectrum that are looking at again, where else can they find returns, considering again private markets as two another source of expected returns that may increase in the future. So Chris, just two last questions rather. Putting yourself as a consultant and then also in the shoes of a plan sponsor, what is that one thing? There's a lot of things that are going on in the world that comes top of mind that keeps you up at night. Again, 30-second response.
Well, I'm going to go with what I said when I was first confronted with that. Will my kids be back in school in the fall? That's kind of the thing that keeps me up at night.
Okay.
And I think the markets have been resilient. So that actually scares me in its own way. That markets kind of bled upwards after such a big dislocation.
And then taking on the opposite of that, what are you satisfied with? What's that one thing that maybe you feel really good about, whether as a plan sponsor, things that you've done really well, or as a consulting firm, that and this just you're really more positive spin on things.
Yeah, I mean, let's take a little historical perspective here. If we go back, prior to the last crisis, I think we had 6 or 8 clients that were doing some form of liability matching. And for them, the pension plan was in some cases larger than the market cap of the company. So it was a critical business issue to address it. Now, we've got 70, 80% of our clients performing some form of matching up assets and liabilities. So we've seen tremendous sell-off in the first quarter in risk assets, tremendous return to them in the second quarter, interest rates coming generally down the whole time. And yet, if you look at pension plans that have good asset allocation, risk management, and if LDI is appropriate, they've got that in place. This has actually not been that bumpy a ride for all the crazy volatility that's happened. So I think good governance, good policies got us into a position where we could weather something that was pretty alarming. That's not to say that we don't have clients whose businesses are really challenged by what may be the new normal. And I think those are really important places to figure out how these plans operate in the structure of an entity that is having to reinvent and figure out what the next few months hold, let alone the next 30 years of the pension.
Okay, great. Yeah. So why don't we turn over to the questions? I believe Kelly might have a couple questions for us here.
Hi everyone, and thank you, Chris and Richard, for your insights. We did have a few questions come in. The first one, you spoke about negative interest rates, and you also spoke about lump sums. Do you see any potential for negative interest rates being required to calculate lump sums?
I think that would be difficult in several ways. I think actuarial-wise, it doesn't make a lot of sense. And I think that, as I mentioned, with spreads, I don't think it makes sense. And finally, politically, I think that would be a non-starter in the organizations that do lobby in Washington for sponsors' interests. There isn't an advocate for people to get lump sums, right? There are people that have lobbied against giving lump sums because they don't want people to go out and buy the boat. But I don't see a political constituency to want to try and have negative rates there.
Okay, thank you. And then the other question is around, we've seen strong equity markets since March and extremely low treasury yields. What are NEPC's views on dual beta strategies that use both equities and long duration fixed income?
So, as I think many of you know, dual beta has been a way that we've used with our clients when it was appropriate as a way to take some risk, but also match some liabilities at the same time. We're definite believers in capital efficiency. And, as you can imagine, those strategies in the second quarter are going to have some of these, super high returns. But we always want to keep in mind and decompose that return into an equity exposure that is a risk factor that we had that hurt us in the first quarter, helped us in the second quarter. And the interest rate thing is matching up to, it is not leveraging up the assets so much as that it is delevering a liability position you already have. And on that basis, they worked well in the second quarter, and they even work well going into the future. Again, this gets back to have the overall objectives of the plan sponsor changed because of the nature of what's happened. And so I could see some changes happening there, some simplification maybe coming out of that. But the general premise behind them actually works very well on a go-forward basis.
So, sounds like those are the only two questions that we had. And wrapping up here, I wanted to thank everybody for attending this webinar. If there is an area that we did not cover or that you wanted us to spend a little bit more time, feel free to reach out to your consultant. As I mentioned, we'll post the webinar replay on our website at nepc.com. And I'd also, again, and in closing, encourage you to participate in that flash poll being conducted by the Defined Contribution team. With that, I thank you again for attending and have a great afternoon.
Thank you.